Các bạn đã thấy cái slide cô chiếu lớn lên chưa? Okay, thank you. And so we start now. Where is the record? Okay, resume the track.
This meeting is being recorded.
Good morning, everyone. So today we will continue to discuss the model CPM. We have already discussed before, right? And today we just spend around from 5 to 10 minutes to discuss a little bit more detail on that. What is the CPM model? CAPM model tells us the relationship between the risk and return. And before, we have already discussed about how to measure the risk of one investment, which is the standard deviation. The standard deviation tells you about the total risk, how it fluctuates, okay? So it's from that one, move to that level and go up. So that's why standard deviation for any investment, for one investment or for a portfolio, all here tell you about the volatility, the fluctuation of the return when you invest. And for that one, we call this is the total risk. And we also have already discussed two types of risk. And for two types of risk, we have one, it affects the whole system. So regardless about how many stocks you invest, one, or even though you invest 100 stocks, or even though you invest for the 300 stocks, those kind of risk, you still have to survive. You cannot eliminate or avoid because it affects the whole system. So that's why we call this one a systematic risk. And because this affects the whole system, so only macro factors will affect the whole system, otherwise no, right? So that's why here we have some macro factors. On the other hand, each firm is unique, and each firm also has its own characteristics, like the management quality, like about the business. Some business is riskier than other business. So that's why some here, and it's affecting just that firm, and it's also come from the unique. So that's why we call this is so unsystematic risk. And because this is the unsystematic risk, because it comes from the unique characteristics of firm. As a result, it does not affect the whole system. We can avoid. It does not affect the whole system, so we can avoid. And even though we can eliminate, that's why you see we have in general, this one is the total risk. And here, this is the number of stocks you invest. Imagine that when you invest only for one stock, okay? So when you invest for only one stock, you will see here, only one stock here. So those systematic risks you face. On the other hand, you also face with the unsystematic risk for that one. So when those unexpected event happen for that firms and you invest 100% on stock A, for example, you will lose money a lot, okay? And imagine that rather than you invest 100% in stock A, now you increase the number of stock. When you increase the number of stock here, you may invest only 5% in stock A and 95% in other stock. As a result, some macro factor happen, you still face with that one. You cannot avoid, even though you invest more than 10 stocks, because it affects the whole system. But for unsystematic risk, now it affects less for your portfolio performance. What does this mean? Because when you lose on stock A, but it affects only 5% of your money, of your fund. That's why we see that the total risk will decrease significantly, and even though it's eliminated. For some level here, we call it eliminate. That explains to you why, at the end of the day, the kind of risk we concern only is about the systematic risk. That also explains to you why we learn how to calculate the total risk, which is the standard deviation. But look at about the return investment required. We do not use that to measure because here, at the end of the day, this one, and finally, it's only those items we concern. That explains to you why in CAPM model, what we concern? We concern about the systematic risk, which is measured by beta, and based on that level of risk, we will determine the return we require or we expect. So we call expected return here. For that structure, they tell us it includes what? It includes the risk-free rate. We discussed about the time value of money already. So money today, it will grow over time, even though there's no risk, because we require at least we earn something if we do not spend money today to enjoy our life. So that's why here it reflects for you about the risk-free, regardless about the risk you face here. But this one we call risk-free. Risk-free means you earn some return without any kind of risk you face, and then it depends on that. Here, it depends on the risk rate. We call that one. And you will see we got that item, market return, and compare with the risk rate. For that one, we call here, this is the premium. The premium. Naturally, because why? When you invest in markets, it means, yes, you face some kind of risk already. And when you take the extra risk, naturally, you require the higher return. Sure, because we are smart, we are rational. So whenever we come and say something, we require higher return. That's why we call this the premium we require when we take the risk. And because we look at that one, only systematic risk, that's why we use the markets at the benchmark. We call this the market return. So, sorry, yes. And in total, this item we call the market risk premium. And here, the beta will measure the systematic risk, but because it's measured in the context of the market. So that's why you see here the beta, we use 1 as a benchmark. We do not go so detailed for that one. This is for the student who specialize in finance. But for this level, you keep in mind that 1 here means we keep the markets. We keep the markets at the benchmark, at the base to make comparison. And here, so that's what you see. Now, we will have that one. First of all, the beta. We keep, yes, we start with that model. The return we require or we expect we call is equal to risk-free. Yes. That's the beta. Market return, risk-free. Okay, and now we will discuss together. When the beta larger than 1, it means for that compared with the markets as a whole, those stocks here, many stocks in the markets, okay, many stocks in the markets. And when macro factor happen, it will affect the whole markets, and those stocks will reflect. For that one, suppose here, it will increase if we got the good news, the good factor, and the stock we are considering increase more than markets on average. So it's larger than 1. On the other hand, some good news, and in case that some bad news or for the macro factor happen, it also affect the markets as a whole, and it make the stock reduce, stock price reduce. And for those stock we are consider, it reduce more compared with the markets at the average. So that's why beta larger than 1 tell you about that kind of stock. It means the stock A is riskier than the market as a whole. And you will see, that means you will check again. It tell you that the investor required for stock A is stand for expected return. Here, you will see they require and they will compare with the market return. What do you expect here? When stock A got the beta is larger than 1, it tells you the picture, the relationship between the stock A and markets as a whole. And for that case, stock A, we can say that stock A is more sensitive. More sensitive means it's increased stronger or it's reduced also stronger with all the stock on average. So we can got a conclusion that okay, stock A is riskier compared with the market. And when stock A is riskier compared with the market, what do you expect for the return, or how much return you require to earn compared with the market return? How much? Is it larger, less than, or equal? What do you expect? So everyone, without calculating budget naturally, when you take stock A which is riskier than the market, what do you expect? What do you expect? Exactly. It's right. Yes, exactly. And we will take it later, but exactly, you will require to earn the return which is larger than return of the markets on average. Okay, this one, so we'll discuss about that more. Similarly, in contrast, in case that's for this one, if we got stock B, for example, and stock B got the beta which is less than 1. It will tell you that picture here, okay, for that picture. For the market, many stock again, many stock. And when there is some positive macro factor affect the markets, it will make the stock of the markets increase. Yeah. And the stock you are considering here also increase, but increase less than markets on average. This one here, less than markets on average. Okay. For the stock is increase more and more, like that one. Similarly, when there is some negative impact that affect the whole system, because this comes from the macro factors and it affects the whole system. That's why we see almost the stock in the market reduce. You see, and of course the stock we are considering also reduce, but it's reduce less than markets on average. So here, that is stock we are considering. And it means we got the conclusion that, yeah, stock B is less risky compared with the markets as a whole. And when you take that one, you will got the return you require to earn inspection compared with the markets. And for that one is, do you see here? How much you require? How much? You require which is larger or less than compared with the market return. This one larger, less than, or equal. Exactly. Yeah, exactly. You are totally right. It's fair. It's right. Because when you take less risk, you earn less return. High risk, high return. Low risk, low return. And now, we have stock C, for example. And for the stock C, we will have the beta with T equal to 0. Okay? For that picture, you will see here many stocks in the market again. Yeah. And here, the positive impact, they increase. And if negative factor occur, they will make that decrease. But the stock we are considering here, just stable, unchanged. It's not increase or it's not decrease. So you see here, it means that there is no relationship. Regardless about the markets goes up, markets go down, whatever. But that's one investment we are considering is just stable, unchanged. So it's rank you first, the beta, tell you about the relationship between the stock, between the one investment with the markets as a whole. And for that one, when it's 0, you will see. So it means that security C, you invest, you face absolutely no risk. Because why? Markets fluctuate, but risk is uncertainty. And when you invest in investment C, you face no uncertainty. You are sure at the return you will earn. So that's why no risk. And when you face no risk, how much return you expect to earn? When you face no risk, how much return you expect to earn? Can someone give me? You face no risk. You still earn return, sure, because we know that it's our money. Rather than we enjoy our life now immediately, now we postpone, but we postpone for what? Actually to earn something more in the future, even though we face no risk. Pure English. So how about the return you require to earn? Exactly. Yes. Excellent. It's equal to markets or it's equal to risk rate? Risk rate is right. Yes, because you face no risk. So the return you expect to earn equal to risk rate. Yeah. And also now we have another case to see. Do you agree? You face no risk, so you earn the return, which we call risk-free rate, the return you earn when you face no risk. And we have another stocks. This one I call security investment C rather than stock, because stock is always risky. We cannot say that some stock is risk-free. Okay. So now for stock D, we have another one, which is beta equal to 1. When the beta equal to 1, so similarly, those stock here, it goes up when, it goes up when we have the positive impact or this one or negative, and negative impact for that. It reduce. And on average, we have some stock here on average, not so strong, but also not so quick on average compared with the markets. On average, so this one something higher, like this one, but something is smaller, but on average. So that's one. We got a conclusion that stock D is as risky as the market. And for that case, how about the return you expect to earn? How about the return you expect to earn compared with the market return? Equal, exactly. It's equal, is right. Yeah. So this is for all 4 CAPM model. First, we explain why we do not use the standard deviation, which measures the total risk, to determine the return investor required, because some kind of risk we can eliminate. The second one, we move directly to the beta, and beta here tells you about a systematic risk. Why is it a systematic risk? Because it reflects for you about the relationship between one investment and the markets as a whole. So that's why you see, no conclusion on the return, we do not say at a specific number. No, we tell in the relative approach, means we compare with the market return, larger, higher, lower, or equal. And for some special case, we compare with risk-free. Okay, so that's it for CAPM model. Yeah, oh, it's okay. And here, this one should we graph. We graph for you to see, but we have already done before. Okay, so you see. If the beta equal to 1, sure, you can put in the model and the return you earn is market return. Okay. I would like to say this here again. And if the beta is less than 1 here, put in that model when you got the information. Yes, you got the return less than market return. If the beta, which is larger than 1, so you see here, the return you require to earn is higher than market return. And when the beta equal to 0, no risk, and the return you earn on that one is risk-free. Okay, for CAPM model. Okay. And now we have 3 cases, 3 stock security, A, B, and C. So you see, you may have the I think 3 minutes to discuss with your friends if you like to discuss. Now, we have 3 options, A, B, and C. Which one based on CAPM model? Based on the relationship between the risk, which is measured by the beta here, and about the return investor required. Yeah, this tells you about the relationship between that. We have 3 options. And my question is, which one you prefer to choose? B, C, or A? B, C, or A? Can someone? If you got this one, if you try to choose the correct investment and give me some explanation on that, you got 5 points for bonus. A, B, and C. So I'm sorry, C here. So I refer to you. That's one, the C. So now, which one? Which investment you choose based on the risk and based on the return? And here, though here the return you will earn if you invest in stock B. This is the return you will earn when you invest in stock A, and this is the return you will earn when you invest in stock C. 3 options here. So could you please tell me which one? Which one you refer to invest? I thought that's for one statement. B, because the higher return. Okay, higher return than what's high risk, high return? Is it right? High risk, high return. So the higher return is enough for you to make chúc Hà. Could you please explain a little bit more detail? Why you choose stock B and you say that stock B got higher return? Oh, Chanton said that B because B is less risky than C and higher return than B. So, girls, first of all, they make a comparison between B and C. Your friend said that B faces less risk than C. Exactly. But B generates a higher return than C. So make the comparison between B and C. We do not invest in stock C. I totally agree with you. Yes. Yeah. But how about between A and B? So, Chang Chen and Chukha, yes, you got 3 points for bonus. 3 points for bonus. And because you choose the right investment. And now you will get more 3 points for bonus if you provide more detail for explanation. Yeah, I see. But now I would like to say that how about between A and B? Between A and B, is it right? A is low return but low risk. So how can I make that decision between A and B based on your argument? If I base on your argument, how about A and B? Because B and C, I totally agree. That B got a lower grade compared with C, but a higher return. However, between A and B, high grade, high return, low grade, low return. So which one? Yeah, so low risk, low return, high risk, high return. Is it fair? I found that one student had picked the point when see on the line. Yeah, I think you can develop on that one. Your friends mentioned the stock is lie on this one. And when it lies on this one, what does this mean? We call SMR and CM. Excellent. I will show here. Okay. So all of you got 3 points for bonus, but I'm sorry that you cannot got the full bonus. Okay, I will show you here. First of all, the red line tell you about the relationship between risk and return. Because you refer B, I will show you the reason why. First of all, look at this one. At that level of risk, based on the relationship between risk and return, this is the return you require to earn. Yes, we see, based on the CAPM model, this is the return you expect to earn. Based on that, based on the level of risk, you determine the return you expect to earn, and it's reflect on the red line, this one here. And now you invest in B, you can earn the return which is higher than what you require, higher than what you expect. So you invest. You are so happy. You feel so happy. And why you can invest on that one? Because the stock PE cheaper than it should be. So we call this one is underpriced or undervalued because it is cheaper than it should be. It is so cheap. It is so cheap. So we buy and we can earn higher than what we want. Because here, the risk we face, which that's one, the risk we face for stock B is some beta here. Based on what we face, this is what we require and we feel happy already here. However, because the price of stock B is cheaper than it should be, undervalued. So that's why you can earn which is even though higher return on that. So that's one. Or we can say that this is undervalued or underpriced. The price is so cheap. So we invest. Yeah. So you choose B. I totally agree when you compare between the B and C. But compare between B and A, we still say high risk, high return, low risk, low return. So this argument is need to be stronger. And for this stronger, we explain by that. Okay, for that level of risk, this is the return you require. And when you invest, you can earn even go higher. Why is so high? Because the price is cheaper than Swiss franc. Rather than this one, they sell at 50,000, but now they sell at only 20,000 the number for one stock, for example, so cheap. So that's why you can earn higher return. Okay, is it clear to everyone? Is it clear to everyone about why we choose stock B? Yeah. To everyone, is it clear why we choose stock B? We put in the concept of CAPM model and we explain the way we do. Otherwise, students tell me that's okay, it's fine, but how about the rest? Is it okay to everyone? Yeah, okay. Thank you. I would like to make sure that everything is fine. Similarly, we say that C, stock C here, this is the level of risk. For that level of risk, it's right, we should require the return here because so high, so risky. But unfortunately, the return we can earn is even though lower than what we require. Why? What is happened? Because the price of that investment is so expensive. When it's so expensive, we call this one is overpriced or overvalued. It's so expensive. When it's so expensive, you invest, you buy that one, and the return is now lower. So it should be that one we require based on the level of risk we face, but unfortunately, so that's why we do not invest. Even though we do not see about the B or A, but now only C like this, we still can make the conclusion. So we still make the conclusion based on stock C only. Suppose we do not make comparison with A and B. We make the comparison with C itself based on the level of risk, what we require, and then what we earn. Okay. And how about the A? It's fair. This is the risk we face. And this is the return we require to earn and we can earn. So it's fair. It reflects correct price. So it's up to you. If you want to invest, so you invest. That's all. Yes, this one for CAPM model. What we explain. And in case that you invest in many stocks, not only one stock, many stocks, and we call that we have the portfolio. For the portfolio, very simple. We just check the beta of a stock and the weight we invest in a stock. In general, we have the beta for the portfolio. Keep in mind for me, beta, you can apply that way. Okay? But for the standard deviation, no, we cannot. For the standard deviation of the portfolio, if you remember before, we still take the portfolio as one investment and we still have look at for the senior one, the probability, senior two, the probability, etc. We are not allowed to take like this one, the weight of one stock and the standard deviation of one stock. This one, absolutely no. Because of what? This is the systematic risk. It affects the whole system move. Okay. But for the standard deviation, it is the total risk. Sometimes you see stock A move in the opposite direction with stock C. Like that's one. So we cannot calculate like on average like that's one. We have to consider portfolio as only one investment as well. And we apply like we based on what we expect compared with what we earn in each case, power two, and the probability for each case. Some all of them, we have the variant. Different, okay, keep in mind for me, different, totally different. So this is at the end for the topic risk and return. Is it okay to everyone? And now we move to the last topic. Is it okay to everyone? If it's okay, so we move to okay. Okay, very good question. So now, Huỳnh Thị Xuân Mai, could you please send your question to me? Investment is system or unsystematic risk. So please, Xuân Mai, could you please? What happened? The screen. What happened?
Recording.
Okay. Yes, so now can you hear my voice clearly? Can you hear my voice? So, Xuân Mai, could you please send your question to everyone rather than send it directly to me? So I can give you and your friends my answer. Your friend asked me here. Okay, everyone, please read that one. What do you think? Systematic risk. Yeah, so you see, very good question here. And we have the exercise to do that. First of all, I will give you straightforward. First, if they ask you about systematic risk, the systematic risk, directly go to that one, beta. Which stock got the higher beta is have the higher level of risk in terms of systematic risk. So for systematic risk, look at the beta to got the answer. Which one is higher? Got a bit higher beta? Which one is risky? For the total risk based on the standard deviation. This one for total risk. And which one is total risk? And so now for unsystematic risk, it's right. This is the question. Unsystematic risk. For that one, you have to combine. You have to combine between the total risk and systematic risk. Suppose if stock A got a high total risk and stock B, so this one is high, and the beta is low. Based on two combination here, because we cannot, for this level, we do not measure unsystematic risk directly. No, the beta, okay, you can measure the systematic risk directly by using the beta. You can measure directly the total risk by calculating systematic risk. Okay, but for unsystematic risk, you do not measure directly. You need to combine between the total risk and because the total risk includes system and unsystematic risk. For example, for this case, you can got a conclusion that, okay, this is got a high unsystematic risk. Stock B, if the stock B got the standard deviation is low and the beta is high, so it means you imagine that the total risk is small and systematic risk is high. It means the rest is unsystematic risk. This one unsystematic risk here. What to say here? This one. High. And for that one, just imagine that here, total risk is small, and within that, systematic risk is high. It means the rest unsystematic risk is low. So that's here. My answer is unsystematic risk for this level. We cannot measure directly. We have to combine because of what? Because this is the total risk, and among total risk we have systematic risk and unsystematic risk, and that's one reflect for you about the level of systematic risk. We have the one exercise, very good exercise in handout to do with that one. So first, you can look at the solution. You can ask the TA, or for the next quiz, I will show you that exercise to do with that one. 10 minutes, I think, to do that exercise when they ask you how to calculate the unsystematic risk. But for this level, they do not ask you to calculate, but they ask you to get the answer high or low for unsystematic risk. And high or low unsystematic risk, you base on that picture, you imagine, and you give the answer high or low. Okay. If you study more, you can calculate and you can give the number for that one. But for this level, first of all, we do not study how to calculate directly. And also for this level, they will ask you that is it high or low, rather than asking you to calculate the number like the beta or total risk. Is it okay to everyone? Is it okay to everyone? It's not okay. Let me know. Okay. Yeah. Very good question. Very good question. Okay, so now we will move to the last one. And for the last one, actually, there is nothing new. Nothing new. Oh, we just apply what we have already studied. Nothing new. So again. Do you see the slide? Capital structure. The current slide. Capital structure. Is okay. So before we study for that one, I would like to ask you, for firm, could you please tell me that for firm, if they want to have the capital to do business, could you please tell me how they can do to raise capital? How many ways that the firm can do? Could you please tell me? Now, suppose your firm want to have money to do business. Tell me which one where they can raise the money. Which one? Okay. Yep. Your friends stress about the stock. They issue stock. Is it right? They issue bond. Okay. They borrow money from the bank. Exactly. So excellent. You got the lecture today already. Yeah, exactly. Yeah. So first of all, what they do to raise the capital, what they do, they can raise with the stock. Yeah. And your friends mentioned that, okay, debt. And among that, your friends suggest they can issue bond. Bond is the debt. It's right because company, they have to pay back. Or your friends suggest that can go to the bank, borrow the money. So we have the bank loans. Exactly. And for stock, they can issue, and there are two kinds of stock. We said it's one for here, the common stock. And another one we call preferred stock. We have already discussed refer stock. And so in general, we got two big financing stock. One is stocks, another one is debt. Stocks mean the companies does not have to pay back. No, when you invest in the stock of the company, you are owner, you are shareholders of that company, and as long as the company survives, you hold that one. Or in case that you do not want to invest, yeah, you can sell the stock and you can transfer the ownership to other. But the company, they do not have to pay you anything. No, that's why we classify as the stock. On the other hand, we classify another kind of financing stock. We call this one is debt. Debt means the company had to pay back. They had to pay back. If they borrow money from bank, they have to bring back money to the bank, and also some interest as well. When the company issue bond, even though for 30 years, the company also had to pay back to the bondholder at maturity date. Is right. So that's why we call this debt. For stock now, companies do not have to pay anything. If they want to pay, they will pay. Otherwise, no. But for debt holder, if the company does not pay, debt holder can bring company go to the court and force company go bankrupt. That's why based on the characteristic of the financing stock, we classify for two. Okay, stock and equity. And among stock, we have common stock and we have preferred stock. For that, we have the bonds and bank loans. And based on the ways the company raise the capital, we call this one the mix. The companies mix between stock and debt. And based on that, we call this the capital structure. Okay. So what is the capital structure? The capital structure is the mix between the equity and debt. So that firm has the capital to do business. That's all. And among debt, they got the short term and long term. But typically, they say that they refer for the long term debt. So borrow for the bank loans or the bonds rather than the payable. No. So that's why more detail, we say that capital structure is a mix between the long-term debt and equity. So that firm got the capital to do business. Why they do not care about the short-term debts? Because the short-term debts occur for gas and pay within 1 year. So that's why look at from the point of view of the cash flow, maybe they do not consider on that, but they refer to the cash for the long term, so long-term debt. And you see, stock and debt, I would say bond or common stock, they are different in terms of risk. For example, you see, compare between the debt holder and another one shareholder. You will see, in terms of firm got the profit, what they do, they have to pay debt holder in terms of interest or in terms of coupon first, and then the rest belong to shareholder or even though nothing or small. It means this guy comes first. Always, this one is always come first. And this one is always the last. Okay, of course, we pay tax to the government. And in terms of the firm go bankrupt, you see, the firm has to sell all assets to pay. And when they sell, what they do, they have to pay the principal or the bank loan to the debt holder first, and then The rest belong to shareholder, even though nothing left for shareholders. That's why you see, in terms of level of risk, bond or bank loans is less risky because they have the priority to receive money before shareholders. So, and because it's got in terms of risk, okay, that's why high risk, high return, low risk, low return. That's why the return investor require when they invest in bond lower than the return investor require on stock. And for investor, we say this is the return investor require. Okay, the return. And when they invest in bond, sure, they also require the return. We call yield to maturity. When they invest in stock, they also require the return. But because investing in debt is less risky, the return is also lower. Okay, so and this is from the point of view of investor. But you see, investor here, they give money to the firm. They give money to firm. And when they give money to firm do business, and then firm give back money to investor. So that's why for investor, this is the return. But for firm, this is we call cost. Because of what? Firm do business and then they need to give money back. And this become the return of investor. But for firm, it's the cost. That's why investor invest in debt or stock, they are the return. And for firm, to have stock, to have equity or to have money in forms of debt to do business, firm need to pay something. And when firm pay something, it's become the cost. And for that one, we call this one is cost of capital. Because the cost of having capital to do business. So that's why you see, for firm, this one is cost of capital. And today we learn about the capital structure and we learn about the cost of capital. And I told you that nothing new to study today because we all study about the return. Investors require to earn when they invest in bond, when they invest in stock. And those return for today just become the cost for firm. That's all. Do you agree? For investor, we call this the return investor require. And for firm, from the perspective of firm, this is the cost of having money to do business, and we call this is cost of capital. Is it clear to everyone why we just switch the term from the return, and the return we study all already for bond, for stock, and for company. We call this one is cost. And because you got many financing stocks, that's why we study on average. On average, I suppose we call this one is either return investor required, is right? In terms of stock. And this is the return investor required in terms of debt here. And for firm, this is the cost. Yeah, this is the cost of having stock, cost of having debt. And we calculate that, sum all of them. We got the average cost of capital. For today, we call this one A for average. C stands for cost of capital. And because we calculate average based on the wage, suppose for that company, they use 60% from equity, 40% from stock. So we have the wage, company grades in forms of stock, and the wage from grades in forms of debt. We got to see, though we ask for you about the average cost of capital, because debt or stock got a different cost. We need to calculate on average. And that's average based on the weight. So we call this one is weighted average cost of capital, WACC. And WACC here, we study on that. And remember for me, for today, we also discuss cost of debt different from cost of equity because you have the right to deduct some cost that before tax you pay. So we have that's one. We consider after tax. Yeah, so that's why in general, what we study today, we classify what is the capital structure. Capital structure is the mix between stock and debt. More detail, we say the capital structure is a mix between the long-term debt and equity. And we will calculate the cost of stock, that's one. And for investor, this is the return investor earn. For firm, this is the cost. We look at that one here, cost of debt. Okay? And we calculate on average. We will discuss this one later, why we consider that one. But it means debt is different from stock. Debt is considered before paying tax. So that's why we consider after tax cost of debt. But that's one we call after tax cost of debt. And though here create for you about WACC, on average, how much the cost of capital firm pay based on the wage from raise capital in its stock. Okay, yeah, so that's one. Now, are you ready to go a little bit more detail? I provide you first of all what we studied today and a general picture. And then now we go a little bit more detail. Are you ready to go for more detail to everyone? Okay, so now that's one here. So I know it's better if we go, but actually I'm not sure that which one is better. But I don't like to go slide by slide because slide by slide is more so detailed and maybe you lost the way, you lost the general picture. So I provide you the general picture first. Okay. Okay, so now capital structure we know now already. Is right? What's in the capital structure? Okay. And we will learn how to calculate that. And we know what does this mean about the cost of capital and on average, weighted average cost of capital. Okay. And to calculate that, we have to deal with the different financing source. And different financing source got a different cost. So that's why we study today cost of different financing source. And measure the capital structure, blah, 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 etc. Okay. Though we study here, but actually we have already discussed before. Yeah, to be designing before, if you remember before, NPV, we learn advantage, disadvantage. We learn how to determine the cash flow in each year. And for today, we will discuss that. And so for that one, we will discuss here. Okay, and then we are completing the capital budgeting as well. Okay, we're completing. We know that, and today we know this one. So everything will be perfect. Right? This is the big idea why we study WACC for today. And then here, cost of capital, we discuss in general, okay? We got this one, but I prefer you to group all at the debt. And because I explained for you before, is right? And this one, we will group in terms of equity. Yeah, they are different. So that's why one firm has to pay back, another one no. And this is in general, but temporary, forget it. This is just actually not so difficult, but it means tell you about the weight of equity. That's all. In total, firm weight in terms of equity and debt, and how much for weight, we look at this one. And similarly, we look at this one. It means this is the weight from weight in forms of debt. That's all. And here they just show you how to calculate the weight. That's simple for you, is right? Here, for debt, they are different because first, firm has to pay back. Second, cost of debt we have after tax cost of debt. For equity, we have only cost of equity. But for tax, but for debt, we have the after tax. That's why you see different. And now, very important here. You see, the difference. For stock or equity, we have only the weight. But, sorry, we have only one cost of equity. But for debt, we have the cost of bond, and then we have after tax cost of bond. You see here, cost of equity, we do not consider about the tax, but debt we consider about the tax. The reason why, keep in mind for me. So here, I will show you the reason why. In general, I will show you here. In general, this is the formula to calculate the WACC. And what is the WACC? We know that already. Okay, but WACC is will equal to the weight from grades in terms of equity. As UE stand for equity, the cost of equity, and the weight from grades in terms of debt and cost of debt. Also here, for the cost of debt, we always consider after tax. The reason why, very important for that one. Okay, remember for me. Now, look at, we have two cases. Case one, case two. For case one, firm do not borrow. Okay, so no borrow. Case two, firm borrow money to do business. And so I suppose firm borrow 100,000 USD at the rate, at the interest rate at 10%. Okay, so now we will start at the revenue. So we would like to explore why we have that item, why we care about that. If firm do not borrow, and another case firm borrow, okay, and as we start at the revenue, suppose the revenue is exactly the same for two cases because firm is right 200 million. Okay, I can for the simple purpose I would like to say 100 million. Yeah, and then they have the fixed cost. Suppose 40. Two cases exactly identical, only different about the. So I'm sure that's maybe fixed cost, variable cost in total. Okay, variable cost in total. Why 80? This one 80. We have the depreciation expense. Exactly. So this one for 20. This one for 20. And now, in terms of profits, we have the interest expense. Because for this case, firm do not borrow, so interest expense is 0. For that case, the interest expense is how much? 10 million. Because you borrow 100 million at 10%, so that's why you have to pay the interest at 10 million. In terms of interest, you have to pay to the bank. Okay. And then you see we have the earning before interest and tax. How much is it for that case to everyone? How much is it for that case to everyone? Please help me.
60.
Yeah, okay, exactly. 60 million, is right. And for that case, how much is it? For the second case, yeah, exactly. So you see here, this is the cost for firm when they borrow money. Is right? 50. This is the cost because why? Now the earning in case you earn, firm earn lower. And lower than how much? 10 million. So from the point of view of firm, this is the cost, is the right cost of borrowing money. Because firm did not have enough money to do business, firm had to borrow money from the bank. And this is the cost. They expect to earn less than 10 million. It's right. And this becomes the cost. When they got only 50 million rather than 60 million, which is lower than 10 million for that one. And this is the cost of debt. You see here? And then I suppose the tax rate is 40%. So how much? How much firm had to pay tax? 24, am I right? 24? Yeah. And for that sake, tax how much? This one is 20. And then we have the net income. Net income for that one is, which one is? 6. 36, am I right? Yeah. And for that one, how much is it? 30, exactly 30. And so you see, at the end of the day, net income is what firm earn, not earning before tax, because tax they need to pay to the government. So that's why you see, at the end of the day, the net income for that one is 36, which is larger than the second case. How much? Only 6 million. Do you see that? Do you see? So firm accept to earn lower than 6 million to have 100 million to do business. Do you see that point? Before they earn less than 10, but actually at the end of the day, compare between two cases, without borrowing and borrowing money, they now earn less than only previous case 6 million. 6 million they earn less. It's right? Over 100 million. This is the cost firm face. This is the cost. So this one 6 million. That reflect for you about actually this is the cost of borrowing, the cost of debt at the end of the day. which equal to 6%, not 10% from the beginning. That explains to you why for the cost of debt, we consider at the end of the day, so we look at about the after tax, how the net impact on borrowing, on firm of borrowing money after tax cost of debt. And it's not just 10%, this is the bank charge. The bank charge is become like this one, cost of debt. However, for firm, how much they have to pay, they look at about after tax cost of debt. And you see, you can check again, 6%, which equal to 10% the bank charge, and then the tax rate. Because 10 million you earn in more in that case, 10 million you earn more on that case when you do not borrow. But among 10 million, you have to share, you have to pay 6 million, 4 million to the government. Because you got more 10 million profit, you have to share 4 million to the government as well. At the end of the day, only 6 million left for you, more than the second case. That's why for cost of debt, you see, that's why for cost of debt, we consider the net impact at the end of the day, which is net income. And the net income, we consider how tax we have to pay if we earn more. So that's why the net is after tax. We only earn lower 6 million, over 100 million of borrowing. So that the cost of debt after tax is the net impact affect firm, which is only 6%, not 10%. That explains to you why when we calculate the cost of capital for debt, we have to take into account that one after tax. And so here, this is the net impact on firm, and we call this is after tax cost of debt. Is it clear to everyone? The reason why different. For dividend you pay later. But for interest, you pay to the bank, or coupon, you pay to the bondholder. You pay before you pay tax. So that's why here you pay before, and then you pay tax. We have here the after tax cost of debt explained to you. This is the net impact on firm at the end of the day. And why not 10%? It's only 6%. We look, compare between two cases when the firm accept to earn less, because to earn less, to have 100 million to do business with them. Cost of that is relatively wide. Is it clear to everyone? Is it okay? Is it fine? Why from the beginning we see the bank charge 10%, but for firm, finally they consider the after-tax cost of debt, how actually they earn less to have 100 million from bank to do business. They accept to earn less than only 6 million compared with the previous case. That's explained to you why we consider after-tax. Is it clear? If not, just let me know. If I go so quickly, just let me know. I will go back again, slowly. Is it clear to everyone? If not so, tell me which point. Do not keep silent. Just tell me which point you want me to clarify again. I didn't see anything in chat box. What happened here? Can you hear me? Why I could not hear you? To everyone, is it okay? Are you sure? Because don't hesitate if you have any question. Because I found that you are not really confident to type yes. To everyone, I ask you again. To everyone, is it fine? Yeah. If not, let me know. Okay. Because when I ask you if you are confident, you will type quickly, otherwise just slowly to say. So, but if you do not tell me, I cannot have. Okay. So that's why I explained to you. One, for the cost of debt, always consider after tax cost of debt. Yeah, in this is the general, but the slide here we do not say. And one important here again, you will see about the weight. Okay, the weight we calculate, but here the weight, for example, the weight of equity depend on the equity over the equity and debt. And equity and debt tell you about the value of firm. That's right. Because the firm is created from the different financing source, which is come from equity, and another one comes from debt. So we call this one is value of firm. And for the value of firm, we focus on market value. We do not look at book value. No. The reason why, for example, Vinamilk. You see, Vinamilk, if you look at the balance sheet, the value of the Vinamilk only reflect the land, manufacturing, equipments. However, in the balance sheet, they do not reflect the values of the brand name of Vinamilk. See, it's invaluable and it contributes to the value of firm. Very important. So when the value of firm increase, it includes tangible and intangible assets. And in the assets, that's one, the value of the brand name of Vinamilk do not reflect in the balance sheet. So that's why book value do not reflect the true value of firm. And here, that's why we look at about the market value. The market value of firm. That's why you see when we calculate the value of firm, we take the market value. And when we take the market values, mean the equity, we also take from the market and the equity and the debt as well. So now for this step, first, keep in mind for me, we take the market value. So we take the price in the markets of equity, of stock. We take the price in the markets of bond. We determine the value. And you see, that's why the price of Vinamilk in the markets, for example, at the moment, which is higher than the book. Why? They consider about the future growth. In balance sheet, they do not reflect on that one. They consider about the brand name. They consider about the reputation. All includes in the price. And they think the value of firm increase more and more and the price more. It creates real value. So that's why we look at the value, market value of firm. And to do that, we also take this one at the market value. So it trades in the markets. And that's one as well. So just keep in mind for me, that's one, and we go more detail later. But I explain to you the reason why we take the market value. Okay? And this one is just example. Here, do not use a book and use the market. Yeah, for that. And how to calculate the market value of bonds or the market value of equity? It goes straight forward. Mean, okay, for bond, we take the bond price in the market. We multiply with the number of bond that firm issue is done for the market value of bond. For the equity, similar. We take the market price of stock because this is determined in the market. We multiply with the number of stock that firm issue. We got the market value of equity. So both here create for you about the market value of firm. And for the bank loan, for example, the bank, normally you take money from a bank, you borrow 1 billion, you borrow 10 billion, and you do not trade in the market, and 10 billion is 10 billion, exactly. So that's why for bank loans, normally they just take the amount of money they borrow from the bank. That's all. And this one, amount of money. Borrow from bank. That's all. Okay. Okay. So we go straight forward. And for this lecture, I refer to use the board to get the general picture rather than slide by slide. So now, in general, you will see here. In general, we have WACC, okay? The wage. We invest in stock. So I refer this one, equity, the cost of equity. Wage, we invest in that. The cost of debt. And always for debt, we consider after tax cost of debt. Okay. And then for the equity, here. And that's one for debt. We will deal with the cost of its financing source. Yeah. And for debt, we also have to share. Okay, we have a comment. First, I refer to save space. I'm sorry. We have a comment. Equity. We have this one is refer. Equity. For that, similarly, we have bond and we have the bank loan. So, based on that, we will determine about the cost of equity. For that one, we need to determine about the cost of debt. Okay. Look at this one. First, we deal with that cost of equity. Cost of preferred stock here. Cost of bond. Cost of bank loans. Okay. Now, we deal with this one. How to calculate the cost of equity? The cost of equity. First of all, look at this one. If you remember before, for the stock, investor, they invest, is right? And what they receive. Can someone tell me when they invest, what they receive? Do you remember what they receive for investor? Yeah, exactly. They receive the dividend. in year 1, dividend in year 2, dividend in year 3, and it lasts forever. Is it right? Who pay dividend? Who pay? Who pay dividend? Who pay dividend? Firms. Exactly. Company. Yes. So that's why for investor, do you see that? For investor, so here for investor, this is the return. This is the return. Yeah. And you see, if the stock is priced at €P and we apply the dividend model, that's model here, is equal to the dividend in year 1 minus this one. This is the growth rate, and this is the return investor required to earn. Do you remember that model? Do you remember that model? To determine, this is the bond, this is the stock price, this is the dividend for the second model, is it right? Constant value. This is the dividend investor will earn. This is the growth rate of the dividend, and here this is the return. For investor, this is the return. And for investor, this is the return. How about for firm? What do you call? For firm, what do you call? Exactly, this is the cost. So that's why this is the return for investor. Yeah. And but for firm, we call this one is cost of equity. Is it okay to everyone? This is the way we determine for the cost of equity. Very simple. We check the return we studied before for investor who invest in stock, and now for firm, it's become the return. Sorry, for firm, it's become the cost, and we determine the cost of equity by that way, by this formula. Do you agree? So when we have the stock price, we have the information of dividend and growth rate. This one is the cost of equity. And for equity, we also study another way to determine about the return investor required. Do you see that? This is the level of risk that investor take. And based on that, investor will require the return they earn. And investor require the return they earn. Is right? For that one, this is also become the cost for firm, and this is the cost of equity. Is it clear to everyone? For cost of equity, common equity, we have two ways to determine based on which information you have. If you know about the level of risk of that stock, you will know that investor will require. And when investor require return, it's become the cost for firm. And based on that, we can say this is the cost of equity for firm. So two approach for you to do based on which information you have. The first one here, if you have information of dividend and the growth rate of dividend, the stock price, you can determine how much return investor required to earn, and it's become the cost of equity. The second one, if you have the level of systematic risk, you also can determine the return investor required to earn, and it's become the cost of equity. here for firm. Is it clear to everyone? And equity here for common equity. That's right. Yeah. I thought that's only one or two students say yes. So please, if you want to go quickly for the topic, then we done. Please let me know your opinion. Yes or no? If no, we can study more. That's right. Yeah. So just please help me. Let me know what you want me to go further or go back. Okay. So now we finish for common equity. Yeah. Now we look at about the preferred equity. For the preferred equity, what is the difference? Preferred equity or preferred stock here? This is the cash flow for the preferred stock. You will see here, it still lasts forever. Yeah. But for preferred stock, what you receive? You receive the equal dividend. That lasts forever. Equal dividend. Preferred shareholders cannot involve in the firm decision. They cannot vote. But what they do, they got the right to receive the dividend before common shareholder. Okay, but they just receive the equal dividend. So that's why you see here, based on the characteristic for the preferred, we can determine the stock price of preferred stock, and it's equal to dividend. Is right? Divided by the return investor required here. And similarly, this is the return investor required for firm. It's become the cost of preferred stock. Yeah, so this is the way we calculate for cost of preferred stock. We got one way to do that. One approach. We need information how dividend investor required. How about how much investors have to pay? Based on that, we determine the return investor can earn. And the return investor required to earn or can earn determine for you about the cost from the point of view of firm. So we have this one. Is it okay to everyone? First, we look at for investor the cash flow of investment, and the cash flow of investment. For the first case, they will receive dividend year 1, year 2, year 3, and it lasts forever. And dividend grow over time. That's why we got that model, and we determine the return investor required. Particularly for common equity, we have another approach based on CAPM model we studied before. With those kind of risk and systematic risk, investors are exposed. They will require set up the return they require. Otherwise, they do not invest. If you remember before, stock C, you don't want to invest because the return is so low. So that's why you only invest if the return is higher and higher. At least reflect the level of risk you face. So that's why for common equity, you have two approaches to determine. For preferred equity, only one based on the cash flow of investor. Cash flow that investor will receive. And that you know the return they can earn. Just switch on that to firms. We say this is the cost of preferred equity. And so now we move to another one. We see bond. Yeah. So look at the bond. Look at the bond. You will see here. We also say, okay, this is the cash flow investor receive. Bondholder will receive. Is right? What they receive? Can you please tell me what they receive for bondholder? Coupon, exactly. Wow, you still remember even though it's far away, is it, from the midterm exam? Coupon payment. Anything else? Yep, they receive the coupon payment. And when the bond expires, what they receive? Yes, coupon payment and face value. Do you remember, to everyone? We have which famous sentence? Em còn nhớ hay em đã quên? Is it right? Do you still remember something? Yes, okay. And you see, we can determine the which one? Bond price. You see? The bond price. And the bond price was equal to, okay. I do not remember. You see? I do not remember. So determine by that one. To be honest, I do not remember that formula. Okay, so have a look. And so here, what is the return for bondholder earn? What do you call when they keep the bond until maturity date? So what's with the return they earn? What do you call for the return they earn? Excellent. Wow, some students can tie even though the formula to calculate the bond price. Excellent. Thank you very much. Exactly. For bondholder, if they keep the bond until maturity, this is the return they earn. Yield to maturity. Do you agree? And for investor, real to maturity is the return they earn. So for firm, this one, investor, the return they earn is yield to maturity. And so for firm, it becomes a what? To everyone, for investor, yield to maturity, this is the return they earn. And for firm, it's become what? To everyone, for firm, it's become what? Yes, and how about for firm? So now, I found out some students, it's right, you have to move a class a little bit earlier to go to school. So now, at the moment, please, all students, please say yes to me in the window. So this is the quick way for me to check attendance, okay? Before you move to the class. So now, quickly, everyone. So, okay, please type something in the window chat or chat window. So that's why I can check attendance. Yeah, and so now for the student who have to go to the university, okay, you can move and then please see the record. And for the record, you do not need to look at from the beginning, but look at for 20 minutes later, okay? Yeah, so now we will continue. For firm here, yes, it's become the cost. And we call this one the cost of bond, or we can say cost of debt. This is the way we do. So here, that's one here, yield to maturity. This is the cost of debt. Is it clear to everyone how to calculate the cost of bond? The cost of bond is just the yield to maturity because investor earn. Who pay coupon to investor? Firm. So that's why it's become the cost. Firm got the money from bondholder, and then in the future, firm had to pay the coupon payment to the investor. So we call this a cost of debt. And cost of debt, how to calculate that? Is equal to yield to maturity. Okay, that's one. Is it okay to everyone? Now we finish for the cost of bond as well. And the way to calculate the cost of bond is we calculate the yield to maturity. Is it? It's okay. And the last one for the bank loans. When you borrow from the bank, how much the bank charge you, we tell you about the cost of borrowing money from the bank. For example, if the bank charge you at 10%, 10% is the cost of borrowing from the bank. We do not have to calculate anything because it's so clear. That's okay. You take money from the bank and the bank charge you at 10, 12 or 15%. So that's why in general now, we can calculate the cost of common equity, the cost of preferred equity, the cost of bond, and the bank loans. Is it okay to everyone? We finish all we need. We deal with the how to calculate the weight. That's all. Do you need 5 minutes to ask me any question or to review what we have already discussed? Do you need 5 minutes, or we can go now to discuss about the market values of equity and debt, even though we discussed before already? Which one you refer? Do you want to refer that you have 5 minutes to review again, to have a look, to put a little bit deeper in your mind what we have discussed here? Or everything is fine now? Just go forward. Let me know which one you refer. Or maybe you want to refer 5 minutes to ask me any question in any, not in any language, in two languages, Vietnamese and English. We want to refer, just let me know. So now, first, we go further. Or we take 5 minutes for you to review, to summarize by yourself. Let me know which one. Come on, I'm asking you. Let me know what you want. Yeah, so one says 5 minutes, one says continue to study. How about the rest? Okay. Yeah, okay, continue. So I will continue, listen. So now, first of all, in general, you have the general picture here, WACC. Okay, and then we go a little bit more detail to calculate the cost of financing source, and we just break down more and more. We have the common equity, we have the preferred equity, we have the bond, and we have the money borrowed from the bank. And then we discuss about the cost of each financing source. Just keep in mind, always we got 2 point of views, like 2 faces of a coin. One investor, we just look what investor receive in terms of cash flow. It will determine the return investor required to earn, and bring that with the return investor required to earn, bring to the firm, and it's become the cost. That's all. And cost of equity, cost of preferred, what's else? And so now we look at about the weight. Is it right? How to calculate the weight of equity. So I would like to find another column to see. Maybe this one. So colorful for you to wake up. The weight of equity, the weight of preferred equity is right, and the weight of bond, as well the weight of bank loans. Okay, and so first of all, to determine about the weight, we take here In general, yeah, let me just check here, sorry. We just check this one, for example, equity, but I refer to you the common equity, so small one, common equity. And then we consider all the equity, the preferred if you have, the bond, and the bank. Oh, but and the bank. So here, in general, the weight of common equity or the weight of preferred or etc. we determine by that approach. Just use that approach. We do not need to discuss about that. And now we will discuss about the market value. Okay, we discuss about the market value. So the market value of equity. We check here the bond price in the markets. Very simple. The bond price in the markets. And in case you do not have the bond price, okay? In case that you do not have the bond price, what you do? You base on the information you have about the dividend, the growth rate, you can calculate the bond price in the markets. And when you got the bond price, you should multiply with the number of bond. The number of bond company issue, they will tell you. And you determine the market value of equity. Similarly, you can calculate the bond price of the preferred. You can calculate the price of the preferred stock based on that one, based on that flow. So you see here, you also got the formula to determine the bond price. And don't worry, if they provide you the stock price, sorry, not bond price, the stock price, they ask you about the return. If they require you to calculate the stock price, they have to provide you the return. If they ask you to calculate the return, it means that the bond price, because it's very clear how much investor pay, how much investor receive, determine the return. Or in the opposite, how much return investor can earn, how much they can receive will determine how much they pay, just based on that formula. And you can deal with that. Similarly, to calculate the market value of preferred stock, we also take the stock, the price of preferred stock. We multiply with the number of stock. That's all. And to calculate about the market value of bond. So we have here the market value of bond. Similarly, you see how much investor can receive, how much investor can earn. Based on that, you can calculate how much investor have to pay. So that's why we also take the bond price here, the bond price, multiply with the number of bond. So we have the market value of equity, the market value of the preferred. Maybe I would say the preferred stock. Market value of bond. Oh, create the market value of firm. And the last one, okay. And the last one you will see here, how to calculate the market values of bank loans. Because that one is not trade in the market. So we just take the amount of money you borrow from the bank. That's all. You take 10 billion from the bank. This is 10 billion, exactly. And it's also contribute to the value, the assets of the firm. So that's why just equal to the bank loans. That's it. And when you got all market values of the different financing stock, sum all of them is create for you about the market value of firm. And then you take each item here, divided by that, you got the weight. So we're done for this lecture. Is it okay to everyone?